It happened in the blink of an eye. You went to sleep feeling secure, watching the price of silver climb past $115, feeling like you had finally made the right move to protect your family's wealth. You woke up to a sea of red, a 30% drop, a vertical red line on the chart that looks less like a market correction and more like a crime scene. The mainstream financial news is already running the headlines they had prepared weeks ago. The silver bubble bursts. Speculators wiped out. Why cash is king again. They are telling you that the run is over. They are telling you that the squeeze has failed. They are telling you to sell what you have left and retreat to the safety of the Canadian dollar. They are lying. What you witnessed yesterday on February 1st was not a natural market event. It was not a change in fundamentals. It was a calculated, coordinated, and desperate execution of the final paper trap. It was a sabotage. And the fingerprints on the weapon do not just belong to the faceless traders of Wall Street. They belong to the very institutions you trust with your mortgage and your savings, the Canadian banks. Welcome back to Canada Property Watch. We have spent the last few weeks warning you about the insolvency of the banking system and the collapse of the real estate market. Today we are exposing how those two disasters are connected to the sudden crash in silver. We are going to explain why the banks needed to dump silver to save themselves, how they manipulated the paper market to trigger your stop losses, and why selling your physical metal right now would be the single greatest financial mistake of your life. This is the story of the Great Flush. And if you are holding silver, you are the target. To understand why this crash happened, you have to understand the terrifying position that the major banks find themselves in. We have documented their exposure to toxic commercial real estate loans. We have documented the bail-in risks. But there is a third pillar of their insolvency that we rarely discuss: their massive short positions in the precious metals market. For decades, the global banking cartel, which includes the major Canadian bullion banks, has managed the price of gold and silver. They do this to maintain confidence in fiat currencies like the US dollar and the Canadian loonie. If silver were allowed to rise to its true fair value, let's say $200 or $300 an ounce, it would be a signal to the world that the fiat currency is worthless. It would be a fire alarm ringing in the global economy, screaming that inflation is out of control and the debt system is broken. So they suppress it. They sell paper silver on the COMEX futures market. These are contracts that claim to represent 5,000 ounces of silver, but they are not backed by physical metal. They are I owe us. For every ounce of real silver sitting in a vault, there are potentially hundreds of ounces of paper silver traded. It is a fractional reserve scheme, just like your bank deposits. When silver broke past $100 last week, the banks panicked. They were caught on the wrong side of the trade. They were short, betting the price would go down, while the market was rocketing up. This created a short squeeze. They were losing billions of dollars every hour the price stayed high. If the price had kept going to $150, some of these banks would have faced a margin call so large it could have triggered a systemic collapse. They were staring into the abyss. So, they fought back. They executed the paper dump. Yesterday, during the hours of lowest liquidity, when the Asian markets were closing and the London markets were opening, billions of dollars in notional silver contracts were dumped onto the market instantly. This wasn't physical selling. Nobody was backing up a truck to a refinery and offloading tons of metal. This was a computer algorithm selling digital promises. Simultaneously, the CME group, which runs the exchange, raised the margin requirements. This is the amount of cash a trader needs to have in their account to hold a silver contract. By raising margins suddenly, they forced the small, leveraged investors, the retail traders, the little guys, to sell immediately to cover their positions. They couldn't afford the new ante. This triggered a cascade. The stop-loss orders hit. The algorithm sensed the weakness and piled on. The price collapsed from $115 to $85 in a straight line. It was a masterclass in market manipulation. It was designed to do one thing: break your psychology. They want you to look at that chart and feel fear. They want you to feel stupid for buying at the top. They want you to capitulate. Because if you sell your physical silver back to the dealer in a panic, guess who buys it? The banks. They use the paper price to smash the market so they can scoop up the physical assets at a discount. They are covering their short positions with your metal. But here's the secret they are desperate to hide. The physical market did not crash. If you think the price of silver is $85, try to buy it. Go to your local bullion dealer in Toronto or Vancouver or Calgary. Call the online dealers. Ask them if they will sell you a silver maple leaf for $85. They will laugh at you. We are receiving reports from across the country that premiums have decoupled from the spot price. The spot price says silver is cheap. The street price says silver is unobtainable. Dealers are stripped bare. The Royal Canadian Mint has warned of delays. The supply lines are dry. Why? Because the China shock has not changed. As we reported, China has effectively locked down 70% of the global silver supply for their strategic reserves and industrial manufacturing. They are building solar panels, electric vehicles, and advanced missiles, all of which require massive amounts of silver. They are not selling, they are buying, and they are buying physical. While Canadian banks are playing games with paper contracts, the industrial giants of the East are draining the vaults. This is the disconnect. We are living in a dual reality. There is the paper world where bankers control the price, and there is the physical world where supply and demand control the price. The paper world crashed yesterday. The physical world is in a super cycle. Now, let's bring this back to the Canadian context. Why are Canadian banks specifically involved in this dump? Why do they care so much? It ties back to the Canadian dollar. The loonie is currently one of the weakest currencies in the G7. The Bank of Canada has signaled that it cannot cut rates further without crashing the currency, but it also cannot raise rates without destroying the housing market. They are trapped. In this environment, gold and silver act as a report card for the currency. If Canadians start dumping their loonies to buy silver en masse, it accelerates the velocity of money. It creates a flight from the currency. The banks need you to stay in the system. They need your deposits to fund their underwater mortgage books. They need your liquidity to prevent the bail-in scenario we warned you about. Every dollar you move into silver is a dollar that leaves the banking system. It is a dollar they cannot leverage 10 to 1. It is a dollar they cannot use to prop up the condo market. It is a dollar that escapes their control. This is the war on cash, evolving into a war on real assets. By crashing the paper price of silver, they are trying to make the Canadian dollar look strong by comparison. It is an illusion. It is like painting over a crack in the foundation of a crumbling house. The house is still crumbling. The final paper trap is designed to shake out the weak hands before the true repricing occurs. History shows us this pattern repeats. In the 1970s, before silver went to $50, which would be hundreds of dollars in today's money, there were massive 30% to 40% corrections. These corrections are designed to transfer wealth from the impatient to the patient. If you sell now, you are handing your wealth to the very institutions that caused this mess. You are selling your life raft to the captain of the Titanic. Let's look at the technicals of the dump. The volume of selling yesterday exceeded the entire annual mining production of the planet. Think about that. In a few hours, they sold more paper silver than every mine in Mexico, Peru, and China produces in a year. How is that possible? It isn't. Not in the real world. It is only possible in the fantasy land of derivatives. This proves that the price discovery mechanism is broken. The price of silver is no longer determined by miners and manufacturers. It is determined by high-frequency trading algorithms programmed to protect the solvency of the bullion banks. But this game has a mathematical limit. Eventually, the buyers stand for delivery. Eventually, the industrial users, Tesla, Samsung, the solar giants, demand the metal. You cannot build a solar panel with a paper contract. You need the physical element AG47. When the physical vaults run empty, the paper market will implode. The spot price will become irrelevant because nobody will trade at that price. The price will be unobtainium. We are approaching that moment. The inventories at the COMEX and the LBMA, London Bullion Market Association, are at multi-year lows. They are running on fumes. This crash was likely a desperate attempt to cover their shorts before the vaults hit zero. It was a Hail Mary pass. So, what is the strategy for you? The Canadian property watcher, the realist, the person trying to survive the economic winter? First, do not capitulate. If you hold physical silver, whether it's maple leafs, bars, or junk silver, do not sell. Do not look at the spot price and feel poor. You still have the same number of ounces you had yesterday. Those ounces still represent the same amount of purchasing power in the real economy. The only thing that changed is the number on a screen manipulated by a criminal syndicate. Second, recognize the trap. Understand that this volatility is a feature, not a bug. They create volatility to scare you. They want you to think silver is risky, so you keep your money in safe GICs or bank deposits that are earning negative real rates. They are weaponizing your emotions against you. Third, buy the blood. Sometimes, if you have cash on the sidelines, cash that you can afford to lock away, this is the buying opportunity of the decade. This is the blue light special. You are getting the opportunity to exchange dying fiat currency for strategic assets at a discount. But be warned, you must buy physical. Do not buy ETFs, exchange traded funds like SLV. Those are paper vehicles. If the system breaks, those ETFs will settle in cash, not metal. You want the coin in your hand. Fourth, prepare for the rebound. When a market is artificially suppressed like this, the rebound is like a beach ball held underwater. When the pressure releases, it doesn't just float to the surface, it rockets into the air. The fundamental shortage has not been solved. The mines are not producing more. The demand is not falling. And the next leg up will likely take us past the old highs and into uncharted territory. We also need to talk about the psychological warfare being waged on you. The media narrative is shifting. They are calling silver investors conspiracy theorists. They are mocking the idea of sound money. This is gaslighting. They are trying to make you doubt your own eyes. You see the inflation at the grocery store. You see the shrinking packages. You see the exploding cost of living. That is the reality. Silver is the hedge against that reality. When they mock you, it means you are over the target. The Canadian banks are playing a dangerous game. By crushing the silver price, they hope to buy time. They hope to extend the life of the fiat system just long enough to transition to central bank digital currencies, CBDCs. As we discussed in our previous videos, the ultimate goal is total control. A world where you hold physical silver is a world where they cannot control you. A world where you hold CBDCs is a digital prison. The crash in silver is the artillery barrage before the infantry charge. They are softening up the resistance. They want to demoralize the sound money movement. They want you to give up and accept the digital yoke. But look at who is buying. Central banks around the world, China, Russia, India, Poland, Turkey, are buying gold and silver at record paces. They are dumping US and Canadian government bonds and buying metal. Do as they do, not as they say. If the central banks are stacking metal while telling you it's a barbarous relic, they are lying to your face. This 30% drop is a test. It is a test of your conviction. Are you a speculator looking for a quick casino win, or are you a guardian of your family's generational wealth? If you are a speculator, you probably sold yesterday. You took the loss, you played their game, and you lost. But if you are a guardian, you smiled. You saw the price drop and you saw an opportunity to stack more ounces for your children. You know that in 2026 or 2027, when the currency crisis hits its peak, nobody will care about the dip in February. They will only care about who has the metal. The final paper trap is closing. The door to affordable silver is shutting. The premiums are the warning sign. When the divergence between paper and physical becomes too large, the market breaks. We are close to that break. The banks have played their hand. They have dumped their paper. They have fired their shot, and yet, silver is still here. The demand is still here. You are still here. Do not let them shake you out. Do not let them steal your future for pennies on the dollar. Hold the line. We will continue to track the dealer inventory levels across Canada. We will let you know when the physical shortages become critical. Until then, ignore the noise. Ignore the red candles. Watch the fundamentals. The paper price is a lie. The ounce in your hand is the truth. Subscribe to Canada Property Watch. We tell you what the banks are doing, not what they are saying. Stay liquid, stay physical, and don't fall for the trap.